Every bubble feels safe until it doesn't. In 1929, people believed stocks could only go up. Families mortgaged everything. The Great Depression erased it all. In 2008, people thought housing prices could never fall. Banks sold toxic debt disguised as gold. When the bubble burst, millions lost jobs and homes. And today, we're hearing the same story again. Tech will keep markets rising forever. It feels different. But so did every bubble in history. The truth is simple. Bubbles never announce themselves. They look rational. They make skeptics look foolish. They reward blind optimism. Until the moment they collapse. So here's the real question. Are we living through the biggest bubble in history right now? And if we are, how do you protect yourself before it pops? The American stock market is breaking records. The S&P 500 is trading at valuations higher than any other time in history. Yes, even higher than the dot-com bubble. Higher even than the roaring 1920s. By every historical measure, this is uncharted territory. But price alone is not the whole story. The deeper problem is concentration. For the first time ever, so much of the market depends on so few companies. Apple, Microsoft, Amazon, Google, Meta, Nvidia, 6 giants carrying the weight of the entire index. Together, they are worth trillions. Together, they explain most of the market's gains. Without them, the S&P 500 would look far weaker. It looks unstoppable. It feels like a golden age. But beneath the surface, the structure is fragile. Imagine a skyscraper, not held up by hundreds of steel beams, but by just a few massive pillars. As long as those pillars hold, the building stands tall. But if even one of them bends, the entire structure trembles. That's the risk we face today. A market at record highs, but with a foundation dangerously narrow. And here's the trap. These companies aren't empty promises like the dot-com era. They are profitable. They dominate global markets. They generate billions every quarter. That's why so many investors say this time is different. But history tells another story. When too much depends on too few, the system becomes fragile. One earnings miss, one unexpected regulation, one global shock, and suddenly trillions in wealth can disappear. Not gradually, but violently. The illusion of stability is always strongest right before it breaks. This is not the first time investors felt invincible, and it won't be the last. In the late 1920s, America was booming. Credit was easy. Speculation was everywhere. People believed prosperity had no limits. Then confidence cracked. Interest rates rose. The market collapsed 83%. It took 25 years to recover. In the late 1990s, the internet promised to reinvent everything. It did reinvent the world, but not before investors paid the price. If a company had .com in its name, billions flowed in. Many had no profits. Some had no products. When the bubble burst, the Nasdaq crashed 80%. The new economy quickly became a graveyard of failed promises. Then came 2008. The story was different, but the pattern was the same. Americans believed housing prices could never fall. Banks offered mortgages to anyone. No income, no job, no assets. Still approved. Wall Street packaged those loans as safe. When default surged, the illusion collapsed. Banks failed. The S&P 500 fell nearly 50%. And millions lost home, savings, and hope. Every bubble feels unique while it grows. The technology is new. The narrative is exciting. The optimism feels justified. But beneath the surface, the story is always the same. A balloon inflates. Confidence builds. Skeptics are silenced. And then, the pop. Sometimes the fall is fast. Sometimes it drags on for years. But the ending is always the same. Euphoria turns into fear. Fortunes turn into ashes. Generations are scarred. History repeats, not because markets forget, but because people do. Every bubble has its excuse, its reason to believe, its story about why this time is different. In 1929, the excuse was endless prosperity. In 2000, it was the internet. In 2008, it was real estate. And today, the story is technology. The market's fate rests on a handful of companies. Apple, Microsoft, Amazon, Google, Meta, Nvidia. These are not fragile startups. They are global empires. They earn billions every quarter. They dominate industries. They shape culture itself. That's what makes this bubble harder to see. Back in 2000, many dot-com firms had no profits. Some didn't even have real businesses. It was speculation on dreams. Today, these giants print cash. They don't play the game. They set the rules. And that feels different. It feels safer. It feels stronger. But that feeling is exactly the danger. When too much power is concentrated in too few players, the system grows unstable. It doesn't matter how profitable they are. It doesn't matter how dominant they seem. Because even giants can stumble. One weaker earnings report, one new regulation, one technological disruption, one geopolitical shock, and suddenly, the market that looked unstoppable starts to crack. Consider this. Since 2012, the S&P 500 delivered about 11% per year. But if you remove the 5 biggest companies, that return falls to just 6%, almost half. The illusion of broad prosperity is really just the success of a few. Even within that group, much of the recent surge came from a single name. VIDIA, one stock riding the wave of artificial intelligence, responsible for a disproportionate share of growth. That's not diversification, that's concentration. And concentration is fragility. Picture a bridge supported by a single pillar. As long as the pillar holds, the bridge looks unshakable. But if that one support weakens, the entire structure is at risk. This time is different. Those are the 4 most expensive words in investing, and every generation pays to relearn that lesson. Every bubble needs a pin, a single event that turns optimism into panic. The problem is, no one ever knows what that pin will be. It could be a small spark. It could be a major shock. But history shows it always arrives. And today, the backdrop is already dangerous. The Federal Reserve may be cutting short-term rates, but long-term U.S. interest rates remain at levels we haven't seen since 2008. The 30-year Treasury yield sits near 5%. That's not just a technical detail. It's a slow poison. High long-term rates make mortgages more expensive. They suffocate heavily indebted companies. They pressure banks already under stress. And they force Washington to spend more and more just to cover interest on the national debt. Right now, the U.S. pays over $1 trillion per year in interest. That number is almost as large as the defense budget. And history warns us, when a superpower spends more on debt than on defense, decline usually follows. At the same time, the U.S. keeps borrowing at wartime speed. In just 6 months, over $1.6 trillion was added to the debt. And yet, there's no war, no massive emergency, just deficits spiraling out of control. The more debt America issues, the higher the yield investors demand. The higher the yield, the heavier the burden of interest. It's a vicious cycle, and the world is noticing. For decades, treasuries were the safest asset in existence. Foreign governments piled them up without question. But for the first time since 1996, central banks now hold more gold than U.S. bonds. They are quietly trading dollars for metal. That shift tells us something important. Confidence is fading. So what does this mean for the stock market? It means liquidity is draining. Money that once flowed easily into equities is being pulled into government bonds. Investors see high yields and move away from risk. At the same time, valuations are stretched, concentration is extreme, and confidence is fragile. Add it up and you get the perfect setup for a correction. It doesn't take a crisis. It doesn't take a war. It could be something as simple as a disappointing earnings call from a tech giant, or one weak jobs report, or a sudden geopolitical flare-up. One trigger, one pin, and the bubble can burst. Corrections are not rare events. They are part of the game. The only question is when and how deep. Since 1920, the S&P 500 has dropped about 5% 3 times a year on average. 3 times, every year. And nobody calls that a crash. It's just normal turbulence. Deeper corrections, 10% to 15%, are also common. They usually last around 70 days, long enough to test your patience. but short enough to be forgotten when the next rally begins. Then there are bear markets, drops of 20% or more. On average, they happen every 7 to 10 years, and they cut about a third of the market's value. The average duration? Almost a full year. A year of fear. A year of headlines about collapse. And beyond bear markets, there are crashes, the devastating ones. 40% or more wiped out. These are rare. But when they happen, they leave scars that last for generations. Think of 1929. An entire decade of prosperity ended in days. The Great Depression lasted more than 10 years. It reshaped global politics and economics. Think of 2008. The crash destroyed trust in banks, in regulators, in Wall Street itself. The effects lingered for over a decade. Even today, many Americans never recovered. These are not just numbers. They are lives, families losing homes, retirements destroyed, dreams delayed for decades. That's why the phrase, "this time is different," is so dangerous. Every generation believes it. Every generation pays for it. The cycle is always the same. Optimism grows. Euphoria takes over. The market climbs higher than anyone imagined. And then, reality bites. The question is not if another correction will come. The question is only when. And the investors who understand this are the ones who survive. Because corrections are inevitable. But devastation is optional. You can't control when the market falls, but you can control how prepared you are when it happens. The first step is simple. Build an emergency fund. 6 months of expenses, kept in safe, liquid assets, treasury bills, high-yield savings accounts, money you can reach instantly. Why? Because when crises hit, cash is survival. It keeps you from selling assets at the worst moment. It buys you time to wait for recovery. Think back to 2020, when the market collapsed during the pandemic. Those without reserves were forced to sell. They locked in losses. And when stocks bounced back, they were left behind. An emergency fund isn't just money, it's peace of mind. The second step is diversification. Don't put your future in the hands of a single market. Spread your risk. U.S. stocks, international stocks, real estate, REITs, bonds, gold, even Bitcoin. Different assets react differently to crises. When stocks fall, the dollar often rises. When confidence in the dollar fades, gold tends to shine. When inflation eats cash, real assets hold value. Diversification won't make you invincible, but it makes you resilient. The third step is discipline. Keep buying, even when fear is everywhere. Especially when fear is everywhere, it sounds counterintuitive. But the data is clear. From 2000 to 2024, $10,000 invested in the S&P grew to over $70,000. But if you missed just the 10 best days, your return dropped by half. Miss 40 best days, and you're almost at zero. Here's the twist. 7 of the 10 best days happened right after the worst days, which means if you sell during a crash, you almost always miss the rebound. That's why discipline matters. Buy when it feels uncomfortable. Buy when headlines scream panic. Buy when others are selling. Because the greatest gains come disguised as fear. The market will test you. It will shake your patience. It will tempt you to quit. But wealth belongs to those who stay invested, not to those who try to time the storm. Crises are painful, but they also create opportunity. When the market falls, some investors panic. They sell. They lock in losses. They swear never to trust Wall Street again. Others see something different. They see discounts. They see assets on sale. They see the chance to build wealth faster than in any calm period. History proves it. The greatest fortunes are often made in the darkest times. Because prices fall faster than fundamentals. Because fear drives assets below their true value. And because most people are too afraid to act. That's the difference. The unprepared suffer. The prepared grow stronger. But preparation is not just financial. It is also mental. You need the right mindset to survive volatility. Understand this. Markets will always rise and fall. You can't predict the timing, but you can control your behavior. Discipline beats emotion. Patience beats panic. Consistency beats chaos. Imagine a forest fire. It looks like destruction. But after the smoke clears, new growth begins. Crises work the same way. They burn away excess, they reset the system, and they create space for renewal. The key is to position yourself so you survive the fire, so you can be there when growth returns. That requires three things: reserves to endure, diversification to protect, and discipline to keep investing. If you master those, you stop fearing downturns. You start seeing them as opportunities. You realize that the real risk isn't a market crash. The real risk is being unprepared when it happens, because every collapse plants the seeds of the next boom, and only those ready to act will benefit. Every bubble feels unique. Every generation believes the story, and every collapse proves the same truth. The market rises, confidence grows, euphoria takes over, and then the fall. The question is not if, it is when. You can't predict the exact moment, you can't know the trigger, but you can prepare. Build your reserves, diversify your portfolio. Stay disciplined when fear takes control, because history rewards patience. It punishes panic, and it destroys those who believe this time is different. Remember this: every crash creates losers, but it also creates winners. The difference is preparation. When markets collapse, wealth doesn't disappear. It changes hands. It moves from the impatient to the patient, from the fearful to the disciplined, from the unprepared to the prepared. That's why mindset matters. Money is not just numbers on a screen. It's behavior, it's emotion, it's discipline under pressure. And here's the paradox: the times that feel the most dangerous are often the times that hold the most opportunity. So ask yourself, when the next bubble bursts, because it will you be a victim of panic? Or will you be ready to act with clarity? Every dollar you save today is more than money. It's a silent worker. It never sleeps. It never asks for a raise. It works for you in the shadows, through every crash, through every storm. And when the dust settles, it's those silent workers that build real wealth. If this video helped shift your perspective, like and subscribe for more stories that reveal how money really works. And tell us in the comments, what's your strategy to prepare for the next correction? Because remember, you can't stop the storm, but you can build a ship strong enough to sail through it. And if you want to go deeper, don't stop here. Click on one of the videos on your screen right now. Each one will take you further into the strategies, history, and mindset shifts that can change the way you build wealth forever.